Joining us now to talk more on markets ahead of today's Fed decision, Kari Firestone, CEO of RES Asset Management, a CNBC contributor. A little better this week, I guess, Kari, but still down 9% since August. Since August, when people finally got all the perma bears got a little bullish right at the top, which is the way it happens. You have a good feel for what the rest of the year looks like, and then we'll talk about 2024.
Hi, Joe. Well, of course, that's the tough question. What about the rest of the year? What we know is that the market got a little oversold. It got too expensive at the end of July, considering all the risks that were obvious, and pricing was way up, and people were just so enthusiastic about the market just in time for earnings to start coming in, and people thinking, oh my gosh, maybe we're going to see softness and a recession, and so they sold off 11% really from the top. So now we're up 2% from the bottom. What does that mean? I don't think you can read the tea leaves very well. You've got some good factors. On the one hand, there's lower inflation. Interest rates look like they're going to be stable here for a while. We know that we're not in a recession, 4.9% GDP growth for the third quarter. I mean, that's phenomenal. Even if it's 2% in the current quarter, that's not a recession. So we're out of that hot water right this minute, but we've got another war to worry about. We might have a government shutdown. So you've got this balancing act. Let's stay out of a recession, have the consumers keep spending money, but if we get too expensive on a multiple basis, or investors start to worry about just valuations, I think that they might sell off again. So, we feel comfortable if we hold steady and maybe move up a little higher from here. That would be great. Earnings weren't bad either.
If you look at things half empty or half full, I don't know if I was on a debate team, I'd take the half empty scenario right now. And that's usually wrong.
Well, most people do.
Stocks go, but I think it's even more right now. I mean, we're. Valuations are at a point where you would think things are pretty good. Instead, we're either going to get more rate hikes if the economy stays strong, or we're going to go into a slowdown, which could be much harder than the soft landing we're predicting. Right now, people are assuming 2024 earnings are going to go up. That might not happen if we have a slowdown. And then you mentioned geopolitically, this is the toughest period people have seen probably since the late 70s in terms of just the black swan events that are now something that we actually talk about. So what was your positive? Your positives were we're not in a recession right now and inflation is coming down a little bit, but valuations are high. So what's that?
Well, I think inflation has come down a lot.
Right.
Okay. So Joe, inflation has come down from 9% to 3.5%. So that's quite a lot. And interest rates have been the factor that have been most important in concern. But if we're at this level, if 5%, and if the 10-year at around 5, remember the 10-year really hasn't finished a day where it's kind of stayed above 5. If it stays at this level and has an effect on the economy, which it definitely is, if you look at the fact that the housing market isn't really moving, housing prices are high, it's not moving. The auto market is being hurt by interest rates. If you look at orders for capital equipment companies, I mean, Caterpillar suggested yesterday that it's not just construction that's affecting them, it's certainly interest rates. So we are seeing an effect of higher rates, and the Fed is very aware of that. That's why they're not raising again. So if we stay at this level and inflation is below 5%, it is, if it's 3.5%, you have a real rate. And then what you're really saying, if you don't invest in the market, is that 5% is a much better return than what the market can do for you. And it's conceivable with the damage that's been done over this year in most of the market. Remember, the S&P 500 on an unweighted basis is, flatter down. So most stocks haven't moved. And if they earn more than 5%, if you have them going up, 8%, that's return that I think justifies investments in the market.
We didn't even talk about our fiscal situation either. And that maybe that's a longer term concern, but it's like, I guess we'll deal with that someday. But we're at 120% 25% of debt to GDP right now. We've never been that high since World War II. And we assume the dollar stays the reserve currency, but there's no guarantee that the dollar stays the reserve currency. That's what MMT people are counting on, that we can always do this.
Sure.
But that could come home to roost. I don't know. I'm in a sour mood in terms of maybe it's because I was preparing for Druckenmiller later. So we'll talk to Stan. He thinks we could be flat for 10. Said that last time. Yeah.
You're usually more positive, Joe. You're usually more positive.
I'm not feeling it today. I'm not feeling it. I'm preparing.
I'm sorry
getting
about
ready.
that.
I got my helmet on. No, I got my helmet on for Stan at 7.